The market rallied strongly early this week with news of many states planning to reopen their economies, but after a sharp sell-off on Friday, the S&P 500 closed slightly down for the week at minus 0.2%. Hello and welcome back to the Wall Street Petting Zoo. This is our This Week at the Zoo segment in which we review the market news for the previous week and offer some forecasts for the week ahead. I am Christopher Smith.
And I'm Robert Coburn. This week was a really important for corporate earnings, so let's take the news sector by sector, starting with travel and transportation stocks. This sector started the week strong on Monday with a rally as investors anticipated the reopening of state economies. On Wednesday, travel stocks also got a big boost when the pharmaceutical company Gilead report positive clinical trial results for its COVID-19 drug remdesivir. Hope I didn't butcher that. But travel stocks struggled later in the week. On Wednesday, rental car company Hertz declared bankruptcy, and airplane manufacturer Boeing reported terrible earnings and announced that it may take 2 to 3 years for airplane demand to return to normal and that they're going to have to downsize. The company cut a deal this week to borrow $25 billion to get it through the pandemic. And on Thursday, United Airlines posted a first quarter loss, but not as bad a loss as analysts expected. American, however, sharply missed analysts' expectations for both its earnings and revenue. Airline stocks sold off at the end of the week, especially after analyst firm Evercore came out on Friday with a $1 per share price target for American Airlines because of the company's enormous debt. Wow. And to make matters worse for travel stocks, Warren Buffett announced over the weekend that his hedge fund, Berkshire Hathaway, has sold off its entire position in airline stocks. So this sector is probably going to tank on Monday.
Yeah, Warren Buffett going into this pandemic was one of the big advocates of airline stocks. So for him to sell off his entire position signals a major loss of confidence in the sector. And Buffett, of course, is the classic like value investor who really spends a lot of time looking at balance sheets and financials and stuff. So for him to dump all of his airline stocks really signals that this sector has had a major change in its underlying fundamental value. Energy stocks had a similar sort of week. They started the week off with a strong rally on hope of economic reopening and rumors of a bailout for oil companies. However, they ended the week with a sell off after Chesapeake Energy and Ultra Petroleum declared bankruptcy, Marathon Oil announced big layoffs, and the oil majors posted terrible earnings reports. On Thursday, Shell's earnings slightly beat analyst expectations, but they fell about 50% year over year, and the company slashed its dividend by two-thirds, saying it didn't make sense to borrow money in order to pay investors dividends. BP's profit fell by two-thirds, and their debt and cash flow are at the worst levels in 5 years. And even after making big spending cuts, BP still needs the oil price to rise nearly 50% from the current level just to break even. They need $35 per barrel to reach their break even point. On Friday, Exxon and Chevron both beat earning expectations for the quarter, but both companies lost significant chunks of revenue and warned that the second quarter will be much worse. Keep in mind, these earnings reports that we're getting right now are from the first quarter, so these reflect, several months ago. We're currently in second quarter, and second quarter has been quite a bit worse than the first quarter, so there's more bad earnings coming in the next quarter. Both Chevron and Exxon held their dividends steady, but keep in mind, Exxon has raised its dividend every single quarter for the last 13 years. So for them to hold their dividend steady is actually a major black mark on Exxon for investors. Investors were sort of expecting, I think, another dividend raise in keeping with Exxon's long tradition, and it did not do that. It froze its dividend for the first time in 13 years. So, pretty bad news from energy companies, including the big oil majors, but especially bad news for the small oil companies that seem to be declaring bankruptcy.
Yeah, let's move on to tech stocks. Major tech stocks, specifically FANG, started the week with sharp losses. That might be because on Monday, the U.S. changed a regulatory rule to make it easier to restrict imports of semiconductors, and airplane parts from China. Donald Trump this week started beating the trade war drum again, saying that the U.S. may punish China for its COVID 19 cover up by imposing new tariffs on Chinese imports. Tech stocks rallied midweek after strong earning reports from Microsoft, Facebook, Google, Twitter, Tesla, but they sold off again at the end of the week, partly on trade war fears. Tesla led the way down on Thursday and Friday after Elon Musk had a bit of a meltdown on Twitter again and posted that he thought Tesla's share price was too high and that he's selling off all of his worldly possessions, including his house. Amazon also got crushed after a terrible earnings report on Thursday. Amazon sales were strong for the quarter, but their costs were so much higher that they missed analysts' expectations of their earnings by about 20%. Next quarter will be even worse. Amazon expects to spend its entire second quarter profit on costs related to COVID 19. This was a huge blow to investors who viewed Amazon as the stock to buy in order to profit from this pandemic. It just goes to show that predicting this market is really hard and that supply chains are just as important as sales.
Yeah, and speaking of supply chains, Robert, one of the big stories we're following right now is the price of food. The price of grains like corn, soybeans, and potatoes have been dropping like a rock due to huge surpluses. Potatoes aren't a grain, I realize that. Now that I'm realizing what I just said. But yes, grains and plant products, mostly the prices are dropping. But the price of animal products like meat, eggs, and dairy are going through the roof due to shortages of those products. The problem on the meat side seems to be that the meat processing plants are experiencing labor shortages and they can't keep up with the demand. So it may be a good time to buy a company like Kellogg that buys a lot of grain, and a bad time to buy a company like McDonald's that buys a lot of meat, because McDonald's and Wendy's and others are experiencing not only higher prices on those products, but in some cases, total supply chain disruptions. Wendy's announced over the weekend that they're experiencing supply chain disruptions in their hamburgers. The McDonald's CEO said this week that they're very concerned about the meat market, that they haven't experienced any supply chain disruptions yet, but they are watching it hour by hour, which means they really are worried about this. And on Thursday, I heard my first story of a McDonald's in Ohio that is only selling chicken sandwiches because beef is too expensive there right now. There is an executive order that Donald Trump came out with, I think, on Thursday or Friday, that basically ordered the meat processing plants to stay open in order to prevent these meat shortages. And there's some indication that that's having an effect to help resolve this meat supply shortage. So we'll see what the effect of that executive order is. But the reality is that these plants are just having a hard time finding workers. And so I don't know if an executive order is actually going to really resolve this problem.
Yeah, that sounds like a weird executive order because it's a labor shortage, not an hour shortage.
Yeah, well, there were a few meat plants that had shut down, and that was part of what was contributing to the epidemic. Was basically states had ordered these meat plants to shut down. But yeah, the labor shortage basically is preventing even the ones that are up and running from operating at full capacity. So we'll see what happens.
And we haven't even talked about economic data yet. On Wednesday, the first quarter U.S. GDP number came in at negative 4.8%, which was over 1% worse than expected. It was significantly better than the GDP numbers for Europe, however, which came in closer to negative 15%. I guess all that government stimulus helped stabilize the numbers here in the US. Meanwhile, projections for second quarter GDP have been all over the map. The Federal Reserve seems to be expecting about negative 10%, but the big investment banks like JP Morgan and Morgan Stanley are expecting anywhere between negative 25% to negative 40%. Pretty much any way you slice it, second quarter GDP is going to be much worse than the first quarter. We'll get to the second quarter numbers later this month.
Yeah, and then there are jobs. The weekly jobless claims numbers have been stabilizing a little bit each week, getting a little bit better than the previous week, but we still added another 3.8 million Americans to unemployment this week, bringing the total to about 30 million in the last 6 weeks. Keep in mind also that a lot of people are still having a hard time even applying for unemployment because the unemployment offices and websites remain so overwhelmed that they can't handle the demand. So actual numbers are probably higher. I am starting to hear stories about people in very serious financial trouble out there maxing out their credit cards just to buy food. And of course, we haven't got the latest bankruptcy and default data yet, but uh, default tends to be highly correlated with unemployment. So as unemployment goes up, you can expect to see major defaults on loans, mortgages, credit cards, etc. And of course, all of that is going to affect bank earnings in a big way this quarter. So I think banks have a lot of headwinds as we just pile up more debt and pile up more people on unemployment.
Yeah, and there's also plenty more we could talk about. There was lots of PMI data this week showing huge contractions in the services and manufacturing sectors. China still hasn't got its factories back to full capacity, which suggests that reopening the economy here in the US may be slower than some expect. Investors have been gobbling up corporate junk bonds because the Fed is supposed to be buying them, but it turns out that the Fed hasn't bought a single one. Apple and Qualcomm posted great earnings, but Qualcomm expects phone demand to fall off by 30% next quarter. The Federal Reserve is starting to scale back its stimulus. Those are just a few highlights from this crazy market right now.
Yeah, personally, I think the news narrative is going to turn a lot more negative in May. There will be less government stimulus, and there will be more bad earnings and economic data. And we're also going to find out that there are a lot of logistical hurdles in reopening the economy, that it's going to be harder than it sounds, and it's going to happen a lot more slowly than investors have expected. In technical terms, we got rejected from a major moving average on Thursday. We hit the 200-day moving average in the S&P 500 on Thursday. And then on Friday, we broke a support trend line. Over the last month, we've been making this upward sloping trend line in the S&P 500, and we broke that line on Friday. So I suspect that the stock market may be right on the cusp of another major downturn, and that we may see a big red week this week. Let's talk stocks that we watched this week. What were you watching, Robert?
So last week, I said I was going to be watching 3M, CVS, and Amazon. Now, 3M reported earnings on Tuesday, and they seem to be making all the right moves when it comes to shifting around their business to their healthcare business group, where it contributed nearly 12.3% of 3M's total Q1 revenue. Although the stock did hit 160 on the day they reported, it fell back down to where it started the week at 148. I think as long as 3M continues to shift their business to focus on the current global climate, they will be able to come out the other side of this pandemic stronger than ever. I said I was also watching CVS this week. However, it looks like their earnings report got pushed to next week, which is actually it's on Tuesday. So they're actually going to be on my watch list this week. And finally, Amazon, as we talked about earlier, when Jeff Bezos threw investors for a loop, he said that all of the second quarter profits will be spent on its coronavirus response. Now, I can understand the investors bailing on the stock, but for a company spending an entire quarter's profits on developing testing capability for all its employees, personal protective equipment, enhanced cleaning of its facilities, and higher wages for hourly teams is pretty much unheard of in today's work climate. And there are some of you out there that would argue that they should have been doing this since the beginning, which I don't think anyone would disagree with, but hindsight's 2020. Amazon may see a few more dips in the coming months, but I don't think a quarter's worth of profits will prevent them from climbing higher by the end of the year.
Yeah, I think they'll dip in the short term. This certainly is affecting their cash flow. It's a drag on their growth, but on the other hand, this is going to do a lot to sort of build trust in Amazon because they are doing all the right things in order to protect their employees and consumers. So good for them. Um, I watched Gold and the oil tanker company Frontline, and both of those came down this week. Gold is down about 1.5%. It seems to be consolidating at this level for now. But I suspect we'll see another leg higher soon, although I would not be surprised to see some dollar deflation happen this week, which would maybe be bad for gold. So gold might dip again this week. We'll see what happens. But in the long run, I think probably the outlook for gold is that it will move higher. Frontline came down a whopping 15% this week as a sharp recovery in oil prices wiped out some of the oil market contango. Contango is the fancy investor term for when the current oil price is much lower than the futures oil price. Um, that has been keeping oil tanker demand really strong because if companies can make more money by storing oil now and then selling it later, then they need to store it in storage facilities all over the world. So they have been paying high prices for oil tankers. Um, Now that that oil contango is going away, the prices for tankers, the booking fees for tankers will come down a little bit. But still, I would not be surprised to see oil drop again this week. Frontline is still sitting just above its upward sloping trend line. So technically, this stock is still in an uptrend. In fact, on Monday, I may add some shares at $9 per share, which is just above the trend line, and set a stop loss just below the trend line around $8.90 per share. And if it does hold that trend line and move up again, I think we could see $12.50 per share within the next week or two. Let's talk stocks that we are watching next week. Robert, what are you watching?
So, besides CVS this week, I will also be looking at Autonation. Now, Autonation, they're the biggest U.S. automotive retailer, which means that they should be taking a beating on the stock market. But if you look at their stock price, it's recovered about half of its price since it lost in March. They got some public heat after the Washington Post reported what some perceive as abusing the small business loans program that the U.S. government allotted, not because such a big company applied for and received the loan money, but because they used multiple tax ID numbers for multiple loans. Like other companies that got their hand caught in the cookie jar, AutoNation announced that they are returning the loans and only intended to use those loans to pay for their employees, which doesn't really help their stock price. Like oil being hard to find storage for, the same can also be said for car dealerships across the nation because no one is buying cars. And a tip out there for anyone buying a car, I learned something from the last recession in 2008. You can get an extremely good deal on a car when nobody's buying. You may already see it already with dealerships across the US offering 0% APR and extended warranties, basically being thrown in at no extra cost. Enough of the tip, though. Let's get back to the stock itself. A lot of dealerships analyzed where they get money from after the last recession and realized that the service center is where they can survive. And a lot of dealerships invested in the customer experience for that since then. And how do I know that? I previously worked for a company that called Xtime that basically created the software for scheduling and marketing software for the service center at car dealerships. And Autonation was one of their clients. So when people aren't buying cars, they're fixing them, and I anticipate Autonation to cut its forecast, but I think they have enough analytics behind them to recover quickly without the loans.
Yeah, I mean, you might also look at things like AutoZone and O'Reilly as potential investing opportunities for that because, of course, people are going to be fixing their own cars to save money as well. So
Yeah.
those car parts companies ought to do well. I am going to continue to watch Gold and Frontline, both of which might rally this week. We'll see. Um, I'm also closely watching that food industry. We're starting to see nationwide shortages of meat, eggs, milk, and cheese, which will drive up costs for companies like McDonald's, Wendy's, and Jack in the Box, potentially cutting into their profit margins. I actually took a short position in McDonald's on Friday just for fun, meaning I placed a bet that the stock is going to go down. We'll see if that happens. McDonald's has had some good news lately, so they may not actually have been the best company to short on this. We'll see. I'm also considering buying maybe some options calls, meaning a bet that the stock will go up on Beyond Meat. If meat costs rise, then restaurants may lean more heavily on meat alternatives like Beyond and Impossible Burger. So this might be an opportunity for those companies to capture a slightly larger market share. So, a couple potential plays on those food, meat, and animal product shortages. All right, well, folks, if you heard anything on the podcast today that you find useful, please give us a like, share, or follow. go on Twitter. You can follow us on Twitter. I post updates throughout the week of all the latest news so you can get up to the minute news. You can also follow us on Facebook. I'm not quite as active on there, but you can at least get the episodes pushed to your Facebook account as we post them. You can also, underneath our YouTube video, find a link to Webull, a referral link to Webull. If you use that link to open up a Webull account and deposit $100 in your Webull account, you will get some free stocks. We'll get some free stocks, and that helps support the podcast, helps us make more of these great podcasts for you. So thank you so much for listening. Thank you for all your support. You guys are the ones who make this podcast happen, and we are excited to bring you more episodes in the future. And we will see you back at the zoo next week.
See ya.